Hi there, welcome to Kneppy Invests. It is the 1st of September, which means I need to do a bit of an update to the performance of three portfolios I am tracking. I completely forgot about this, and I have set this video up after the trading has finished on the 1st of September. And to be fair with you, the first day of spring was not good for the Australian markets. The major indices were down about 2% for the day, and the performance of these portfolios include the 1st of September. So in fact, this video probably should be called 14 months and 1 day performance update. So let's get stuck into it. And before we have a look at the performance of the portfolios, what do I mean about these portfolios? So for those who have not watched one of these videos before, I'll talk about these three portfolios that I am tracking. The first portfolio is a group portfolio selected, or a group of companies selected by the viewers of this channel. And I asked a question or posed a question to them. What is one or three companies you would own for the next 5 years that you think will outperform the market? So I collated the results and put together this group portfolio, a completely passive portfolio. So no buying or selling of shares. And in fact, one company in this portfolio has been bought out by another company. So I have been thinking about what to do, or is there anything I can do with that extra cash? Also, there's dividends. So in fact, our cash for this in this group portfolio is actually increasing because of dividends and this takeover of this Unity company. The other two portfolios I am tracking are two of my own portfolios using different strategies: a short-term sentiment and trend strategy, and long-time buy and hold strategies. These are two strategies I am using now, and I am thinking about combining these two strategies into the one. Now, these two personal portfolios don't include all the companies I actually do own. I own quite a few more, quite a bit more that is not included in these portfolios, but I kept the amount to these portfolios at $100,000. That's why these two personal portfolios don't include every single investment I do have. Now, before I have a look at the portfolios, the first thing I usually do is just look to see where we are in the overall market. And because I do this update every single month, I think it's a good idea just to look at the monthly chart, focusing on the XJO, which is the ASX 200. And this monthly chart goes back to 2008. And what happened in 2008? That was the GFC. And the reason I've gone that far back is because at the bottom of the GFC, which occurred in March 2009, the XJO was just above 3,200, or around about 3,200. And ever since then, the XJO has been trading up in this trading channel. And only once has this trading channel been breached, and that was during the COVID-19 financial panic. And it was only breached for a very short period of time. We have seen it breached for a very short period of time on the upside in August. I think it was August 2021. You can see there was 11 straight months, I think it was 11 straight months, that the XJO went up, went from the bottom of the channel to the top. And as soon as it hit the top, we saw a little bit weakness in the markets at that point in time. And right now, well, at the end of trading on the 31st of August, so this does not include trading on the 1st of September. So we are right now smack in the middle of this trading channel. So around about 7,000 at the end of trading on the 31st of August. And the bottom of the channel is around 6,200 and the top of the channel is around 7,800. So if you look at in between that, that is right on 7,000. So if you just look at this trading channel and think we're going to continue trading in this channel for who knows how much longer, who knows if the market's going to go up or down from here, because we're right in the middle. But every single time the XJO has gone towards the top of the channel, we've seen weakness. And every single time that the XJO has been at the bottom of the channel, we've seen a bit of strength and a little bit of upside. Now, that does not mean we're going to continue going in this upwards channel, because during the COVID-19 financial panic, in fact, the bottom was 4,400. And that blue line I have, that sloping blue line I have at the bottom here, is the long-term trend, which goes all the way back, I think, to 1981. And during the GFC, the XJO hit that long-term trend and bounced off it during the COVID-19 financial panic. It hit that long-term trend and bounced off it. So we could get back to that long-term trend if there is significant weakness in the market. Who knows what's going to cause that significant weakness? And that means the XJO has the potential to fall as low as 46 to 4,800, depending if we get there, depending how long it takes. So that would be sort of the all-in price I would be willing, or all-in point I'm willing to go all in to spend all my cash I have building right now in my portfolios. Now, before I have a look at the August's group portfolio performance, or the performance of the group portfolio up until August, let's go back 1 month ago. And at this point in time, the group portfolio was down 16%. Now, 16% includes capital gains and dividends. So you always have to include dividends in the performance of your portfolios, also the performance of the markets. I have heard some people compare their portfolio performance, and this is professional people, compare their performance of their portfolios to the XJO or the XAO, which does not include dividends. I think that is a mistake. And that's why I like to compare it to the STW, which does include dividends. And you'll be able to see that during the rest of this video. Anyway, in July, the best performing companies were to the end of July, the best performing companies were Lake Resources, BrainChip, Unity Group, which has been bought out, so no longer trading, and Novonix, ResMed, Talga, and CSL and Woolworths Group were all in the black, all up over the past 14 months. The majority of companies down because we have seen significant weakness in the markets over the past, say, 9 months, eight months right now to the end of August. And we're going to see the group portfolio underperform the market when it's going down in a bear market, and we're going to see the group portfolio outperform the market when we're in a bull market. And we have already seen that happen for the first 6 months of financial year 22. The group portfolio significantly outperformed the market, but when there is overall weakness in the market, we're going to see this portfolio underperform. But over time, the markets go up. So I think over a 5-year period, more than likely, the group portfolio will outperform the market. That is my prediction moving forward. So I wouldn't get freaked out just yet if your own portfolio is underperforming the market. You do have to wait. This is a long-term game. This is not a short-term thing. You shouldn't really be looking at the performance of your portfolio every single day. I think that is a mistake some people do because sometimes, particularly when the market is down 2%, you could get a little bit freaked out. And that's why some people sell at the bottom of the market. That is the worst time to sell. In fact, that's when you should go all in. Now to the performance of the group portfolio to the end of August, plus 1 day, the 1st of September, and the group portfolio down 15.7%. So overall, during August and the first day of September, the group portfolio was up for the month. But when you look at the companies that are in the black, only 7 companies at this point in time, including Lake Resources, BrainChip, Unity Group again, Talga Group, CSL, Novonix, and Woolworths. ResMed is now in the red, BHP in the red as well. Although BHP on the 1st of September went ex-dividend, so a massive amount of dividends for BHP, $851.23. And that's the only reason that's in the red. I think BHP was down something like 8 or 9%. Maybe not that much on the 1st of September. So you do have to take into account when a company goes ex-dividend. Another one of the companies I own, Phoenix, went down 22% on the 1st of September because it went ex-dividend. That company has a significant dividend yield right now because I think the market is completely undervaluing that company. But overall, the majority of companies are still down at this point in time. So that's nothing, again, to be concerned with. And a lot of these companies that are down big, I think, have the opportunity to have a massive rebound in the next few years. So we're talking about EML Payments, Kogan, I'm not sure about Zip, Credit Intelligence, not sure about that, Alcidion, Megaport, Pointera, Ares Resources, Tezzeret is down big. I think that has a significant opportunity to rebound significantly. That company is profitable, and I think Tezzeret right now is significantly undervalued. Even though I'm not a shareholder of that company, I still think it is undervalued. Xero's down a fair bit as well. I think that has the opportunity to outperform the market over the next 5 years. Arctis, Dust Group, Sol Patterson, a company I really like, for the future. Blue Scope Steel, A2 Milk hasn't had a really good rebound over the past few days because of a really good full year result. So I expect that company to go in the black over the next few months. I've already mentioned when the overall market's going up, so when it's in a bull market, I have a feeling, and I think this has already played out in the past, that the group portfolio will outperform the market. And we saw that from the start of the financial year 22 to about January, the group portfolio was significantly outperforming the market. And as soon as we went or had a bit of weakness in the overall markets, that's when we saw the group portfolio underperform. So right now, the group portfolio is down 13.5%. So that includes capital gain, which is negative 15.5%, in dividends. So again, you always have to include the dividends, 1.93%. And the reason I want to compare to the STW instead of the XGO or the XAO is because the STW, which is the ASX 200 fund, also includes dividends. So if you don't include the dividends, the STW is down 6.44%. If you include dividends, which is 6.88%, the STW is actually up 0.5% over the past 14 months and 1 day. Now onto my personal long-term portfolio. And instead of looking at the current state of the companies I own in this portfolio, I'm just going to look at the 10 best performing companies that I've either sold out or are holding in this portfolio right now. And it shouldn't be a surprise, in my opinion, that 8 of the 10 best performing companies are companies I've completely sold out because I took profits. And I'm not the biggest supporter of always taking profits. So I do like the philosophy of letting your winners run. But sometimes taking profits does work. And it's really worked quite well for me over the past 14 months. The only company within the best performing 10 companies in this portfolio that I still own completely is Fiducian, and that is the 10th best performing company. The third best performing company is BrainChip, but even BrainChip, I have taken profits. When the share price of that company got to $1.50, I took profits. Share price of that company is now 90 cents. Some of the other companies here, Revison, I took profits when that company share price was something like 80 or 90 cents. Share price of that company is now 17.5 cents. Alexium, I took profits when that share price was just less than 10 cents. Share price is now $2 or 2.2 cents. MyDeal.com, there was a takeover bid for that company, automatically sell when there's a takeover bid. So there has been no decrease in that company's share price. Another company's share price that has decreased a lot since I took profits is Aussie Broadband. Share price of that company is down to $2.66. And the more that company's share price falls, the more exciting I get, because I think the market has lost its sanity when it comes to that company because of the significant runway of growth that company has in store over the next 5 to 10 years. I did not sell any companies in my portfolio. Now, I am over the next, I'm going to say 6 months, 6 to 9 months, I am going to clean out some of the lower quality companies and start buying higher quality companies and to put into my long-term portfolio. I've already started doing that. Breville is one company I bought. Aristocrat is another company I bought because I thought the value of those companies was quite low. Another company I've just recently bought, the only acquisition I've made during August, was a company called AFT Pharmaceuticals. Ticker code is AFP. Really impressive growth for that company over the past 10 years. The company has become profitable in the recent few years. I think they will start paying a dividend. And the only problem with AFT Pharmaceuticals is the lack of liquidity, because the founder of that company owns a significant stake in the company. So I don't mind about lack of liquidity, because over time, particularly if the company can keep on growing, we are going to see liquidity increase. And there's also the chance in the future that the founder might sell some of his shares to increase liquidity. That would not be an awful thing. So I bought 1,300 shares at a share price of $3. I think the current share price of that company is down to $2.90. But tomorrow, the share price could increase 20 or 30% because of the lack of liquidity. So at the start of this start of August, I did have $13,000 of cash. $208 of dividends was gained. And because of that acquisition of AFT Pharmaceuticals, my cash on hand at the end of August was $12,677. So a little bit of liquidity to play with. And I hope to add to that cash on hand by selling some companies that I think might be good sells. I'm not sure exactly what companies at this point in time, but if any companies that I am thinking of selling do go on a bit of a run in the share price, that's when I will be selling out of those companies. At this point in time, the long-term goal is for the long-term portfolio to outperform the market, and my hopes is for it to double the market returns. And during the bull market, we were seeing that. This portfolio was definitely outperforming the market. And just like the group portfolio, when we are seeing overall weakness in the market, this portfolio will underperform the market. One of the other companies, and the reason why there's a third line in this one, is because that is following American company that I do own, that is PayPal. And right now, PayPal is outperforming my long-term portfolio and the STW. And the reason I bought PayPal, which was quite a few months ago, was because of the valuation of that company. And when I looked at the valuation of PayPal, we saw, I think it was the best time to buy that company in terms of valuation for over 6 years. So the market was getting freaked out by PayPal. They came out with some good results, the last quarter results, and we have seen a share price rebound. And the downtrend in that company's share price looks like it has come to a completion. Now onto my second portfolio. This is using a different strategy, which is sort of a sentiment, trend, momentum strategy. And right now, I have really pared back the holdings or amount of holdings I have in this portfolio. You'll be able to see how active I have been in the next slide. I have not bought any companies, but I have sold out a lot of companies. And in this portfolio, using this strategy, I do let my winners run as long as possible, and I sell out of any of my losers. The reason I do that, and the reason why you let your winners run and sell out of your losers, is because if you do the complete opposite and you take profits and sell out of your winners and keep your losers, eventually you're just going to have losers in your portfolio. So the idea is, if you just maintain a hold of your winners, eventually your portfolio is going to be full of winners. And that's the theory behind why you sell out of your losers. But some people find it really hard to sell out of companies that are down. So I think that is a mindset and a psychological barrier that a lot of investors do have to overcome. So at this point in time, not a lot of companies at this point in time within this portfolio. So I am a little bit bearish in regards to the overall market. So I do want to build up my cash levels, and I've really built up my cash levels right now. The best performing company right now is Neuron Pharmaceuticals, a company that has zero revenue, but that will change over the next few years. And this company has the potential to bring in significant amount of revenue. And that's why the share price keeps on increasing. And that company by far is my best performer. Just behind Neuron Pharmaceuticals, we have Johns Lynd Group, IPD Group, Treasury Wine Estates had a really good 4-year results, and that company's share price is now in an uptrend. MMA Offshore had a good 4-year results. That company's share price is in an uptrend. Ansell had really good 4-year results. Share price of that company is in an uptrend. NRW Holdings had a really good 4-year results. Share price of that company is in an uptrend. West African Resources, even though gold is a little bit bearish right now, the share price of West African Resources seems to be going sideways. So that is one company I could sell. Comply FinTech, Lynas Rare Earths, and Megaport is close to being a sell. So I bought that company at $8, and right now it's at $6.99. So in the past month, I have sold out of 7 companies in this portfolio, and these are all losers. And so every single one of these companies, I was in the red. I did not make money in any of these companies. Actually, except AGL Energy, I did actually make money in that. But they did release their full-year results, and it was negative. The market didn't react good to that results, and that was an automatic sell based off the reaction from the market. So sold out of Packwood, Metro Mining, Hillgrove, Mount Gibson, Costa Group, AGL Energy, and ServiceStream. ServiceStream was an automatic sell because of bad full-year results, and the share price has tumbled a lot since then. Some of the other companies, just because the share price is now in a downtrend, share price just keeps on selling. So quite a few energy or mining companies in here, but overall, the total amount of disposals is $20,036. $155 of dividends, and right now my cash levels is at $55,000, $55,185.92. So a lot of capital to play with moving forward. And if we see some bullishness in the markets, that's when I will start to decrease my cash and increase my holdings, particularly those companies whose share price are starting to increase. Some of the companies I have thought about buying, and those companies include Altium, REA Group, WiseTech. There's a few others here. JB Hi-Fi, XRF, City Chic. More than likely, most of those companies would fit into my long-term strategy, not this strategy. So at this point in time, I haven't found any companies I'm willing to put into this portfolio using this strategy, just because there's an overall weakness in the market and in truthfulness. To be honest with you, and not a lot of companies look attractive at this point in time. Now to the performance of my short-term portfolio, and to be fair with you, I have done much better using this strategy than my long-term strategy over the past 3 or 4 years. However, in saying that, I am shifting my philosophy, my long-term philosophy or strategy from, in the past, I've been very much the risk-taking investor, where I will buy smaller cap companies with a high risk, high reward scenario. And I'm now sort of leaning towards, because I've become a little bit more risk averse, because my risk appetite has changed as I've become part-time, and I'm going to be focusing on higher quality companies like, as I mentioned, LTM, WiseTech, Real Estate Group. All those companies have a high valuation right now attached to them, so they are highly valued, but they are high quality companies. JB Hi-Fi, I think, is a high quality company. City Chic, PFG, which is Prime Financial Group, which is a small cap company, but that company is profitable and is also growing their dividends. So over the next few months, I hope to transition my long-term portfolio to feature more high quality companies. So hopefully when I go down that route, it will outperform the market. The only thing I'm concerned about is when the market rebounds, some of the companies I have in that and some of the companies I might sell might rebound really quick, say go up 100%, 200% in a very short period of time, while some of these high quality companies won't have the capabilities to have that sort of rebound. So that is the one thing that's holding me back by selling some of the lower quality companies in my long-term portfolio. But overall, my short-term portfolio is outperforming the market 2.86% for the first or the last 14 months, while the STW is only up 0.51. So I want to at least double the overall market. Now, 0.5 or doubling 0.5% is not much. So when I say I want to double the overall market, so in 5 years, if the STW is up 20%, I want to be at least 40% higher. No, not 40% higher than market, but I want to be up 40%. So that is my long-term goal. At this point in time, we can't judge the performance of either any of these portfolios because 14 months is simply not long enough. So yeah, so 14 months is not long enough to judge the performance of any sort of portfolio or any sort of strategy. You need longer term to judge the performance of a portfolio. But overall, the first 14 months, the group portfolio is down a fair bit, but I do believe once the markets turn around, we're going to see the group portfolio quickly catch up to the STW and more than likely quickly catch up to my two personal portfolios. But at this point in time, the best performing portfolio is my short-term sentiment. So maybe I should be focusing on using sentiment and momentum and trends as a strategy, because that is the best performing strategy at this point in time. Now, in saying that, past performance is not an indication of future success. So just because that strategy is the best performing strategy over the past 14 months doesn't mean it's going to be the best performing strategy over the next 46 months. Yeah, 46 months, which means we're a quarter of the way through this experiment. Yeah, 15 months is a quarter of the way there. And that actually brings up a thought. I read an article the other day in regards to the worst performing funds over the past year, superannuation funds. And the article suggested those who have their money in these funds should take their money out and put it to the best performing funds. And again, past performance does not indicate future success, or past underperformance does not mean those superannuation funds will underperform over the next few years. And apparently that is a major mistake. A lot of people do is they take the money out of bad performing super funds because they're following the money. And that apparently is a really bad strategy. I'd like to see some research behind it, but apparently, yeah, allegedly it is one of the worst mistakes you can make by following the money, by following best performing funds. So that's just, sorry about that rambling there. If you do have any questions that I've raised up in this video, any thoughts, leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.